The stock market crash of 2001 was a significant event in the history of the US stock market. It occurred in the early 2000s following a period of economic growth and prosperity in the late 1990s. The crash was characterized by a sharp decline in stock prices, particularly in the technology sector. The crash was caused by a number of factors, including the bursting of the dot-com bubble, concerns about corporate fraud, and a slowing economy. The crash resulted in significant losses for investors and had a ripple effect on the broader economy. The government responded by implementing measures to stabilize the economy and provide assistance to affected individuals and businesses. Despite these efforts, the economy remained weak for several years following the crash. Investors should be aware of the potential risks associated with investing in speculative sectors such as technology, and should always conduct thorough research and due diligence before making any investment decision.